Hey everyone, welcome back to Corporate Decoder, the place where we untangle those complicated corporate documents. Today we're digging into the Spinnaker ETF series report, and trust me, it's not as boring as it sounds. I mean, who knew ETFs could be so dramatic? It's a bit like a financial soap opera with twists, turns, and numbers that could make your head spin, so buckle up. These OBRA ETFs are like two sides of the same coin, aiming to make money off structured products. One's playing it safe with high-grade stuff, and the other is a bit more adventurous. It's time to unpack how they're doing, what they're investing in, and whether it's paying off. Before we jump in, if you find value in getting straight insights from corporate reports, subscribe to the channel. There is also a Discord community linked in the description below if you want to share your own take. First up, the OBRA High Grade Structured Products ETF, or OGSP. Think of this as the more conservative sibling. It focuses on those high-grade or investment-grade securitized assets. Let's quickly look at what it costs to run this thing. For every $10,000 invested, the fund takes $91 as expenses. That is 0.90% of the total investment. Keep in mind though, the footnotes tells us because the fund didn't operate for the whole year. So how did it perform from April of last year to March of this year? OGSP returned almost 7%. Not bad, especially when you see that it beat its benchmark, the Bloomberg US Aggregate Bond Index, which only made around 5.7% during the same time. Also, it beat the ISBA Fibra 3-year US Corporate Index, which did 6.24%. So what made OGSP tick? Helped these fancy terms translate to bets on collateralized loan obligations and commercial mortgage-backed securities. How does it look over time? You invested $10,000 on April 9th of last year. You would have around $10,700 by March 31st. Here's the average return over different time periods. Looking at the since inception number, OGSP did almost 7%, again beating the Bloomberg Index's 5.72%. So what's in its investment portfolio? The top sector is collateralized mortgage obligations holding almost half of the pie, or 42.52%. Next is collateralized loan obligations holding almost a third, followed by asset-backed securities with almost 19%. Taking a look at the top holdings of OGSP, the largest slice of the portfolio is Goldman Sachs Financial Square Government Fund at 5.3%, followed by Elmwood 523 Limited at 3.2 to its slightly more adventurous cousin. Now for the OBRA Opportunistic Structured Products ETF, or OSPI. This one's got a bit more spice, aiming for income and capital preservation, but doing it by investing in a wider range of those securitized asset instruments, aka structured products. It's willing to take on more risk for potentially higher rewards. How much does it cost for every $10,000 invested? It takes $92. Just like with OGSP. Then 0.90%, because this figure is based on less than a full year of operating. What about performance? OSPI has returned almost 9% from April of last year to March of this year. Like its more conservative sibling, OAS outperformed the Bloomberg US Aggregate Bond Index. OAS beat the ISBA 3-year BB Corporate Index, which had a 6.39% return. What was its recipe for success? Just like OGSP, it was, had you put $1,000 on April 9th of last year, it would have ballooned to $1080.71 by March. That almost $900 in pure gains. Let's check the average annual returns. Since inception, OSCE raked in almost 9%, again leaving the Bloomberg US Aggregate Bond Index in the dust. Diving into what it invested in, collateralized mortgage obligations are at the top again, making up just over half of the portfolio, or 50.4%, while short-term investments have 29.3% and collateralized loan obligations almost 26%. Looking at top holdings, we see that Goldman Sachs Financial Square Government Fund accounts for almost 30% of total net assets, and Magnetite Exley Limited is owned 2.5%. You can clearly see the difference between the two funds. In the previous one, Goldman Sachs Financial Square Government Fund only accounted for 5.3%. Let's switch over to some hard numbers, starting with the statement of assets and liabilities. The OBRA High Grade Fund had about $27 million in investments, whereas OBRA Opportunistic had about $35 million. The numbers for total net assets follow the same ratio, around $26 million for the High Grade Fund compared to around $30 million for Opportunistic. Here is where things get very interesting. How are the funds actually performing? The Obra High Grade Fund earned $1.8 million in total investment income. Meanwhile, Obra Opportunistic only earned around $1.5 million. Despite Opportunistic controlling much higher value of assets, the High Grade Fund generates more value. The Obra High Grade Fund generated around $1.77 million compared to only $1.5 million for Obra Opportunistic, despite Obra Opportunistic controlling much higher value of assets. Obra High Grade's fund share transactions generated around $26 million. In contrast, Obra Opportunistic's fund share transactions generated $30 million. In terms of efficiency, the ratio of net expenses to average net assets is the same, 0.90% for both funds. The average net assets, which is the average amount of assets each fund controlled over the measured time period, the net expenses are fairly similar. So the funds are being managed pretty similarly in terms of costs. The funds are required to provide information on the distributions made during the period. Those distributions from ordinary income resulted in $1.5 million for the high grade fund and $1.3 million for the opportunistic fund. Taking a step back and analyzing these numbers, a few things stand out. Despite the Obra Opportunistic Fund aiming at risky, higher reward investment and commanding a bigger portfolio, the high grade is generating better ROI metrics. This, in my opinion, makes it the stronger of the two. It's crucial to keep an eye on those collateralized mortgage obligations, or CMOs. The sector's performance has been critical to the fund's success, and it will likely continue to be a big driver for both funds. And another point is the expense ratios are low for both funds, but those are based on less than a full year of operating. Investors will need to see how that metric develops. As the funds become more established, what is my opinion on Spinnaker ETF series? They might need to rethink the opportunistic fund strategy, since the high grade fund is outperforming with supposedly safer moves. However, more data in the coming reports should give everyone better insights. Alright, we went through those complex filings, hopefully in an easy to digest manner. What's your take on these ETFs? Let me know your thoughts in the comments below. Hit the like button if you found this breakdown helpful, and definitely subscribe for more looks into these corporate documents. Also, remember to check out our Discord in the description where a lot of discussion goes on. Thanks for watching, and I will see you all in the next video.